The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
The information here being presented is as of March 31st. So it seems like a world apart. I mean, what's happening today is in many changes changed from the materials that I put together in these slide decks. So I will try to discuss what happened in the first quarter and then try to update you a little bit about things that have changed since then. This first slide basically talks to you and shows you how the markets have climbed, and it shows you the S&P 500 index, and you see it's continually increased. You've had a couple of bouts when things decreased, but in general, the markets have over time have moved higher, and you see that the relevant PEs compared to other time periods. And I preface this also that the PEs are been calculated, so you see different slides with different values. So it's not that they're wrong. Depending on how in the source I use, the calculum is slightly different, so you'll see slightly different numbers. But as of March 31st, on this slide, comparably, I mean, the PE actually dropped because the markets had fallen. And so the critics would claim the market's overvalued. You can make that standpoint, but as of the end of the first quarter, the markets were actually cheaper than they were in other periods. So that's the point of this chart. And also showing you where the forward yield is and the relevant treasury bill. So moving on to the next slide. This breaks down the sectors. So as of the first quarter, the best return was energy, and not surprising with the Iran war happening. As you fill up your gas tank, I mean, I filled up mine this morning, 410. So energy companies are extremely cashing in on the higher oil prices. The other, interesting thing here, like materials, the ability to get raw materials out of the Persian Gulf has also been compromised, leading to higher prices in materials. But as of the first quarter, the biggest negative there, and the surprise is technology. Technology stocks actually dropped in the first quarter. So the trend, and this is somewhat changed in the month after this, but in the first quarter at least, the technology stocks did not outperform, and they're typically the leaders and they're the biggest portion of the market. So, this was quite a surprise and shock to many pundits and markets that going into this year, they didn't expect the first quarter to be led by materials and energy. Next chart. Okay, this basically breaks down the Meg 7. So it's ironic that I have this slide in there. 4 of the companies reported last night, and then Apple's today. And in general, they were all really strong. So, but as of the first quarter, they were all negative here. They didn't contribute anything to the performance, and actually distracted. And that's a reason why the markets were down over 4% in the first quarter. Moving to the next slide. Okay, so market breadth. So at John G. Ullman, we're value investors. So although we own some of the Mag 7, in general, we're value managers. So value managers tend to outperform when just not the Mag 7 are leading the markets, then other stocks are also performing well. So in the first quarter, you see that blue bar, the majority of stocks are actually outperforming the overall index. So, and that's just explained the Mag 7 are down. So not surprising, but as a value manager, you tend to like this when the stocks are, the majority of the stocks are outperforming the index. It gives you more ability to own other stocks than just a handful of big mega cap tech stocks. So, and you look in history, they're back in 2022, it was similar, but over the recent last 10 years, it's been the minority of time where the majority of stocks are outperforming. But back there in the early 2001, 2, 3, it was the majority of stocks. But of recent, this hasn't been. And the irony on this chart is also that in the previous month after I published this has probably gone back to the Mag 7 outperforming the other stocks. So next chart. Okay, so what I really like this chart because it really explains a lot of why the markets are performing like they have. So, they are performing well this year on the basis of earnings growth. So in real estate, it's always location, location, location. But in equity markets, it's earnings, earnings, earnings. And so the growth of the earnings propel the markets higher. And so you see it across the board. And mind you, these numbers are also mostly pre the Iran war. So they might come down, and the expectations are for many people that it's over the course of this year they'll come down. But so far, these companies have been reporting earnings, and mind you, these earnings ended March 31st. So the numbers haven't come down yet, but the expectation is these numbers will come down. But going into this year, and even after a few months, the earnings on the S&P were expected to be in 2026 up 20%, in 2027 up 15%. Even the mid cap up 18% and up 13% in 2027. And small cap also 17% increase, 2027 18%. And then outside of the US, 17% and 12%. And and also that you see there in the PE, the foreign stocks and smaller stocks generally were cheaper than the S&P 500. So in the international, we'll get into this a bit later about the facts about oil, but the idea of growth across the board is what the leading factor of most of the people that are bullish about the equity markets. The strong growth in these numbers they haven't changed dramatically, which we'll go into another slide. Next page, yes. So you see here the continuation of all the years. So U.S., as represented by the S&P 500 index, you see this consistent stream of growing earnings. So we live in a remarkable place where the strength of the companies that make up our markets has been phenomenal over the years. And you see year over year over year, other than a few downturns here, like in 2008, mind you, the overall indicator, and COVID also in 2020, that the chart has led higher. And, it's remarkable. And that's basically why your equity returns have been so phenomenal over the years. The earnings of these companies continues to grow. And as they grow, your stocks will go up with them. Next page. Okay, so mind you, again, this was as of the March 31st. So as of today, when I just looked, P's are probably closer to 21. But as the quarter ended, we were at 19.5. So as I said, critics mostly say that the market is overpriced. Well, I just showed you and talked to you about how the earnings growth is so phenomenal, but also that this PE level has been reached in the 90s, and it was also reached there in 2021 as well. So these numbers do not alarm me. If we were in a PE market where we were in the mid 20s or higher, that would be a lot more alarming to me. So given the growth and given the PE levels, I think this is okay. Next page. So I really like this chart. Again, this one basically tells you, again, we're looking at the profit margins versus PE. So again, as I said, many critics claim that the PE in the market is too high. Well, one of the factors leading, not only is it growth, but it's the profit margins. The mega 7 companies, in general, the companies that make up the S&P 500, have become extremely profitable. Their margins are near record highs, and these are not mean reverting. You see here since 2010 that the profit margin for companies increased from 9.5% to up there at about 14.5%. So historic profit. So the multiple PE model is influenced by not only growth but profit margins, and profit margins are extraordinarily high right now. Okay, next chart. This basically shows you the breakdown. So you see there that the market was led by the Mag 7 for numerous years. And why was that? See there in 2022, 2023, 2024, this enormous profit growth from those stocks, up 38%, 35%, 27%, 20, and 21. And then the rest of the 493 that make up the index are barely growing. You see they're negative 5.3%, up 4.9, up 8%, and then finally, now up 16%. So they are performing again, and they are growing, as opposed to before they weren't growing. So the market was more or less just the Mag 7 and forget everybody else. But now that the other 493 companies are actually contributing to the market, and that's also one of the indications what I showed you that earlier slide, that the contribute for these 493s was actually positive instead of negative as it had been in the past. Okay, next chart. Okay, so as I mentioned, the earnings. It's not just important that the earnings are improving, but it's also the trend. And so the trend of what the earnings are for the S&P has actually been improving as well. And you just see, and again, this is as of the end of March. So I don't think it's dramatically changed from this 319 target, but we'll wait and see what occurs from the situation with the Gulf and Iran. But as of the end of 31st of March, we were still seeing extraordinary good growth, even in the underlying estimate. Next page. Okay, so again, this is ironic that the companies were reporting results last night and telling you how much they're spending on CapEx, and especially, like Google was. And these numbers actually increased from this chart, but you see the dramatic growth in the spending by IT. And a lot of stocks are basically being fed by the by the CapEx spending of these Mag 7 companies, semiconductors, potentially software, utilities, power, all kinds. So the market and the economy in the U.S. now is growing on the basis of this massive $1 billion here. And I have on here for 2026, it was 672. Well, the new number as of last night was over $700 billion being spent. And this is huge and it's massive. It's never occurred in the history of the U.S. such a massive spending by only 7 companies that make up the industry. So we'll see how much this continue and how these companies' ability to actually fund this. And mostly they're funding it with debt and they're funding it with their cash flows. And most people believe it's actually sustainable for quite some time. So as long as it's sustained and it isn't led by massive growth and debt by these companies, basically their growth and their spending can continue probably for the near future. And we're talking about the next 2 or 3 years. Okay, next chart. The Fed. So also yesterday, the Fed came out, Powell's last meeting, and basically this chart indicate, the potential for cuts. Well, subsequent, the oil prices are higher, inflation is running higher than expected. And so the trend would actually be the opposite. There's no expectations that the Fed will do anything anytime soon. And even potentially they may actually hike rates, but the tendency right now is to stay neutral. So, for equity markets and for bonds, you generally want to see the rates go down. And, that's why Trump was pushing to get Walsh to lower rates. It's better for the economy. It's better for the U.S. government when they borrow so much money. It's generally favorable for everybody. But if you push down the interest rates too low, you overheat the economy, and then inflation's already running too hot. So the statement out yesterday was the majority of people prefer a neutral stance currently. Next page. The Treasury. So the Treasury rate, since I put this out, is more or less the same as where it was here. So as I just checked here a minute ago, we're at 4.39%. So generally, this is considered for people that hold it, it's considered a decent return. And as far as the economy goes, the mortgages, credit cards, there's lots of things that are basically built on what the Treasury is yielding. So it's a decent rate, and it doesn't hurt the economy, and it also gives investors generally enough returns to cover the inflation rates. Next chart. Okay, so I threw this one in. I mean, this is generally a reflection of what's the economic situation, but I thought it was ironic that in the past, many people used the inverted curve to indicate when a recession will happen, and that's why I circled the red boxes when that was happening, and you see the recessions in the dark gray boxes, and I mean, you can tell me, and you see that there's some periods where they seem to be right before them, and in other periods they didn't happen. So there's one there, back in 2022, we didn't fall into any terrible situation then, and I don't really think it's a good projection using this, but that's why I put this in the indication. Next slide. Okay, unemployment rate. It's inched up since April of 2023. We're at 4.3% as of when I put this chart in. I think it's April there. Yeah, you can stay here. When I was in school, this was considered full employment. Mind you, like the plus 20, 30 years ago. Right now, though, this rate isn't a bad rate. I mean, but it did tick down, which was a good sign, and people were concerned that it may have ticked up based on the early indications of what's happening in war and higher inflation. But it's basically more or less considered like a full people working. Although, I mean, you hear lots of people saying the job's tough, and generally people aren't getting fired, but they aren't getting hired as much either. So, good indication, a good number, actually. The next chart. Job growth. Job showed 178,000 new jobs added in the first quarter. Very strong. I mean, you see there that was the best number we've seen, for a couple of quarters. And historically speaking, when you go back to 2023, that's a really positive number. And given the fact that people are complaining they can't find jobs, actually somebody must have been, because those numbers that's a healthy number. Next chart. CPI. Mind you, this was only as of the February, so it doesn't affect. I mean, if I had the time, the next one would have been plus 3.8%. But as of February, it was 2.4%, which is around close to what the Fed was targeting, the 2%. But now we're at about 3.8%. So, but again, as I stressed, these charts were reflective as of data as of March 31st. Next page. Okay, also through this one, and again, as the first quarter was going, the inflation in what job wage growth, typically when you're working a job, you want to be making as much or staying even with inflation. And people complain they're not even with inflation, but actually, as this chart showed, the majority of job earners were actually earning above the inflation rate since 2023. But with the oil price now, that you see that spike up recently, the theory would be they're not. I mean, with the oil price now, you're probably not covering. Your wages are probably increasing faster than the cost to you now. But they had been since 2023. From 2023 to the first quarter, the people working in the U.S. were typically covering their inflation. Next page. So the great worry is, how high is gasoline going to go? And I just checked this morning the crude, and this is WTI, not Brent. WTI, based on the Bloomberg forecast, we're saying the longer that the Persian Gulf is closed, the higher the price is. But we haven't reached the heights of what the expectations of these lines are yet. I mean, they're talking 100. You see, they say May by 2026. I mean, we're there basically, and they're saying $160, and we're at 106. So the oil prices seemingly are not as bad as what is feared, but who knows? I mean, what the situation, and listening to the news and Trump saying that this blockade could last for months. So crude was up early this morning. Now it's kind of flat from where it was, but who knows how high oil can go? But we're very fortunate here in the U.S. that we're a net exporter actually. So other economies around the world are much more hooked onto the ability to have to import oil, and U.S. isn't. But I don't know how high this target is, and it hurts everyone. The people that need it for all transportation, for airlines, for U.S. consumers that drive. It's a harmful, hurtful number, except just for energy companies. So I don't know. I don't know where this is going, but the majority of strategists basically predict that. I think the oil markets do. They predict that at some point the blockade ends, the Persian Gulf starts flowing again, and prices start going down. But when does that occur? That's a $64 million question. If you can answer that exactly, you would be a multi-billionaire, because it's extremely difficult. Even the experts, no one has a clue exactly what's going to happen. Next page. So I like this chart, because the first one, it basically shows you at this point, when I put this in, I think, in March, we're there around $4. We aren't as bad as when Russia invaded Ukraine here in 2022. So gasoline prices were actually much higher then. So that brings the question why, and most people can't really answer it, and thinking that oil prices will go higher. But crossing your fingers, oil has not reached those peaks yet, but who knows? Maybe it could. One of the theories out there is that we have great oil destruction. People are driving less. There's more EVs, and the high prices basically mean much less driving, less people flying, and maybe that's enough demand destruction that will make so the oil prices don't eclipse that peak that you see in 2022. We don't know. And then the other side basically shows two different things. It shows that the U.S. is actually, as I just said, we are a net exporter of oil. Previously, in other situations when oil prices peaked, we were much more dependent on OPEC in getting the oil. And right now, that's not the situation. And also, the bottom one basically shows you how much the U.S. consumer, basically percentage-wise, as far as their income, is spending on oil and gasoline. And the good thing is that those numbers are shrank over time. But the lower income people proportionally spend much more. So it's much more hurtful for those people than somebody that a mid-sized wage earner or someone that earns more. But the good thing is currently, as opposed to the previous periods, they are spending less proportionate of their income on it. Next page. Okay, the VIX. I love the VIX because it's a contrarian indicator. It basically measures the volatility of the markets. So when it peaks, that means people are extremely fearful, and typically prices are cheaper on stocks. And vice versa, when the readings are very low, it means people are not fearful, and generally prices are higher. So in general, you want to buy when the VIX is above 30, And if it peaks beyond 50, 60, people are panicking and selling stocks, and generally there's some bargains to be had. So I always love, even Buffett usually said that, be greedy when people are fearful and be fearful when people are greedy. And I think that it notes the VIX. The VIX is, a reading that most people use. And how scary did this when it first started? We peaked about 31. Now we're at 17. And many people will say, well, things haven't really improved much. There's still the blockade. Oil prices are still going up. How come the markets are more fearful? And that's a question I ask too. Shouldn't the markets be much more fearful than what's going on? But I believe that the markets, because of the earnings growth and because we're not dropping more bombs and not setting off more missiles, think that, okay, this will end at some point, so we're not fearful. And that must be, but others may have different explanations. Next page. Okay, forecast. Where is the growth? So this is showing you the Eurozone. It's showing you the Fed and Japan and China. And as you see the bars, our GDP forecast, when I put this together, it was slightly under 2. I think the latest number is actually 1.8%. So Trump always says that we have the greatest economy ever. Well, he kind of admits now after the Iran situation, things are a bit less, but we still have a great 1.8% is a fair reading, but it's not a great reading. Previously, we were expecting far more growth going into this year. We were looking at extremely, really healthy growth, but right now, 1.8% growth is not great, but it's decent enough. Next page. So manufacturing is 20 to 30% of the economy right now. It's much less than it had been in the past. Readings above 50 indicate expansion. So coming in March, even myself thinking that maybe it's hurtful, the inflation and higher prices, but in actuality, the manufacturers as of the March 31st are still doing pretty well. And that's indicated by the 52 there, that they're actually expanding profits and growth. Next page. Okay, federal finance. John here, the CEO of the firm, he loves to talk about how high the federal deficit is and how much we're spending. And we're running well, as of when I printed this, it was $1.8 trillion deficit. Yesterday, the defense secretary was testifying in Congress and requesting nearly $1 trillion in defense spending. These readings are probably low. We're probably looking past $2 billion. And there's no indication that these numbers will come down anytime soon. So we have to pay this sometime, but when your grandkids, great grandkids, it can't continue forever, but seemingly in the near term, it is, and as long as people will finance the U.S. government through buying the debt, it seemingly the Congress will continue spending that money. Next page. Okay, so here is basically the final slide. People are alarmed about the action, and if you look back in history, the returns past 60 days after a military action are actually positive. I mean, it isn't a doom and gloom that we've entered a war or there's some period of military conflict. Typically, the markets are resilient, and it's more based on earnings than it is political concerns and political events. Although I would say that the current situation is different. You could go probably in the 70s when Suez Canal and the Arab War. I mean, that had effect of closing oil markets as well. But Persian Gulf has never been closed before. But as here, they basically show you these different situations that have occurred, and the markets have been really resilient. So we shouldn't fear that there's a military action, but we should be concerned about the ability to open the Persian Gulf and hope that it will happen in a near time term, talking in months rather than years.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.